Hello, and welcome to the next episode of the Capital Stewards podcast. Today, I'm going to talk about moves to consider making when the stock market is down. Market volatility and drops like we've experienced over the last few weeks sometimes makes us want to close our eyes and stop watching our portfolios. And sometimes that discipline can be good, but challenging markets are not the time to run away and hide. It's time to go on the offense so that you can save money on future taxes, transfer assets, and get ready to take advantage of the next market cycle. So in this episode, I'm going to cover 5 things that you should be thinking about now so that you can be prepared to take advantage of market declines, if we have any of those, as we go through the rest of 2025. Our first 2 topics go hand in hand: tax loss harvesting and portfolio rebalancing. Tax loss harvesting leverages market losses by selling off investments that have declined in value. So things that you bought, for $100, and now they've gone down to 90. And we use those losses to offset taxable income and gains in other places in your portfolio. You can store up these losses to use when you have gains either later in the year, or you may even be able to carry some of those gains over into future years. And you might be thinking, but I don't want to sell when the market is down and lock in my losses, right? That's a common thought process, I think, that I hear. And you're right about not wanting to exit the market. You want to stay invested through the ups and downs, but you can sell one security that has declined in value and replace it with a similar security that you don't own currently. Your overall portfolio position, if you do that, is little changed, but you can write off those temporary losses on your taxes. I mentioned the word similar specifically. You can't sell one stock or ETF or a fund and buy exactly the same thing in your portfolio. It's especially common mistake I see with ETFs. The IRS considers ETFs and index funds that use the same index, so for example, the S&P 500, to be identical investments or to be substantially similar. And so you won't be able to use those losses if you say sell the SPY, which is an S&P 500 index, a popular one, and buy IVV, which is another popular ETF that just tracks the S&P 500 index, because those aren't similar economic exposures. Those are the same economic exposure. So when you harvest tax losses, you want to replace that S&P 500 stock index you sold with, say, the Russell 1000, which is just a slightly different basket of US stocks. You'll have similar but not identical returns, but you'll be able to harvest the losses and then still benefit if the market goes back up in the short term. As you harvest losses in your portfolio, you should also be rebalancing back towards your asset allocation targets. As an investor, you want to buy low and sell high. That means when we have significant moves up in the market or down in the market, we should be rebalancing so that we can buy more assets that are relatively cheap and sell the things that are relatively expensive. I know that sounds like kind of elementary, right? Like, of course, Brian, we want to buy low and sell high, and we want to rebalance our portfolio. Yet so few people actually do this, right? It's our own psychology and our own investor behavior that keeps us from having good investment returns so often. And so it's really important that, you say, oh, well, it's time to rebalance when the market's down a lot. It's down a lot because there's a lot of fear. There's a lot of concern about what's going on. So it's now the right time to rebalance and buy more stocks and sell those bonds. It's important to be disciplined and rebalance regardless of how you feel in the moment. Rebalancing and tax loss harvesting in particular can be timely issues. On those days when the market's down a lot, you want to be ready to go in order to maximize the value of the strategies. So that means you need to plan ahead for how you would rebalance and which securities you would harvest losses from and which things you might buy when you do your tax loss harvesting so that you can be ready when the moment strikes. Case in point, after the tariff announcement, the S&P 500 sold off in early April. It was right below 5,000 at the end of April 8th, but on the 9th, Trump announced a delay in the tariff implementation, and the market moved up almost 10% within a couple of minutes. So being able to execute your loss harvesting and your rebalancing quickly when the market's down a lot is key to maximizing value and reducing your taxes, most importantly. So you want to consider these opportunities ahead of time and be ready to go. So that's where I think the value is in this conversation today, is these are things you should be thinking about now so that if we do get volatility later in the year, you're ready to go and execute these strategies, or someone's ready to go and execute them on your behalf. The next couple of items are strategies to reduce your taxes over the long term. Down markets can be a really opportune time to gift assets to your heirs. You've got a lower valuation on those same shares of stock or the same business shares or real estate. So if you have a taxable estate, or if you're close to the estate tax thresholds, then gifting in down markets can significantly reduce the amount of estate taxes that you owe. Again, this is an area where planning ahead of time can be valuable. If your heirs aren't ready to receive the assets, you can still utilize trusts and other estate planning tools to make those transfers in down markets without necessarily giving them full control of those assets. But it takes time to draft those documents. It takes time to come up with those plans. So those are the kinds of things you want to think about ahead of time so that you're ready to push play on that stuff when the moment comes. If you have a 401k or an IRA, down markets are actually a good time to make contributions. The lower prices mean that you're theoretically getting more shares for the same amount of money, that you're contributing, and oftentimes you're maxed out on what you can contribute to those particular kinds of accounts. So if I can buy more shares for the same amount of money, that's a really good benefit over the long run. And then the last point that I want to make here is to think about conversions, particularly Roth conversions. Remember, a Roth conversion is when you transfer or convert assets from a traditional IRA to a Roth IRA by paying the taxes on the IRA that you had originally deferred. So when you make 401k contributions, when you make IRA contributions, you get a tax write-off up to a certain amount for those contributions, but then you have to pay taxes down the road in retirement when you're ready to use those funds. However, when you have money in a Roth, it grows tax-free and you don't have to pay taxes on any of the future gains or on the income when you pass age 59 and a half and when you get into retirement. So once those assets are moved from or converted from the IRA into the Roth, the taxes are paid, they grow tax-free for the rest of your life. Market downturns can help you maximize the value of those Roth conversions. You can move more assets from your IRA into the Roth while sticking to your original tax budget for the year. So instead of having to pay a lot more taxes to do the conversion, maybe you can do it without having to pay a lot more taxes because the market's down, those assets are worth less. Then as those assets, sort of return to the value that they were at previously as they reappreciate, you will have reduced the taxes that you pay on your total portfolio over your lifetime. So in conclusion, there are lots of opportunities for you to take advantage of when there's market volatility and when markets are down, and we're seeing a lot of that so far in 2025. But it's really important that you think about some of these opportunities, decide if they're the right things for you to do, plan ahead and be ready to execute on them as you go through the rest of the year. It's really hard when the market goes down, over a couple of days to go find someone to help you run the analysis, transfer your money around, do all the stuff you need to do before the market bounces back, especially when we've got the kind of volatility that we've seen here lately. So you want to think about this stuff ahead of time and be ready to go when the market's down. So just because the market's down, don't sort of look away, turn away, and go put your head in the sand. Think, what are the opportunities that I can take advantage of even in a down market environment? Maybe I can't grow my portfolio as much as I did the last couple of years, but maybe I can save on taxes, transfer money, do other things that can be really valuable to me long term. So use it as an opportunity to go on offense, not just to sit around and play defense. That's all for today, and we'll see you on the next episode of the Capital Stewards Podcast.